You are listening to CEO Perspectives, a podcast by the Conference Board.
Welcome to this episode of CEO Perspectives, a signature podcast series by the Conference Board. CEO Perspectives are conversations that take an objective, nonpartisan look at a range of timely topics that matter most to business leaders. To help make sense of these topics and how they'll unfold, we'll sit down with thought leaders and do what we do best at the Conference Board, provide trusted insights for what's ahead. I'm Steve Odland, the CEO of the Conference Board and the host of this podcast series, and today's conversation will focus on U.S. inflation. Why are prices climbing at the fastest pace in decades, and what can be done to stop it? Joining me today is Dana Peterson, the Chief Economist at the Conference Board. Dana, welcome.
Hi, Steve. It's always great to be here.
So, Dana, talk about U.S. inflation trends. You know, they were trending up throughout 2021, and now in 2022, we've got the Ukraine situation, which has exacerbated it. But just sort of talk about what was going on, and now what is different.
Absolutely, Steve. So last year, at the beginning of the year, we didn't really see any inflation pressures, and then by the end of the year, that's what everyone was talking about. And what was going on last year was we had both demand and supply side pressures linked to the pandemic. On the demand side, you had a tremendous amount of fiscal stimulus. So people were getting cash injections into their bank accounts, and people saved some of that, people paid down debt, but people also spent a ton of it. And so you had that increase in demand for goods. Meanwhile, on the supply side, you had supply chain disruptions stemming from Asia, also parts of Europe, where you had shutdowns in those regions of their factories. And so you didn't have enough goods. And so strong demand for goods, limited supply, higher prices. And so we saw that really play out. We also saw something called the Great Resignation going on, where many people were deciding that they were fed up or just wanted something different or new in terms of jobs, and they quit, but then they joined other jobs at higher wages. And so we certainly saw wage pressures. Now, we wouldn't say that we were in a wage price spiral per se last year, but certainly many people seeing their wages rise also probably stoked demand and consequently inflation. So those are some of the dynamics that were going on last year.
Yeah, and the whole shutdown, I think, was a global phenomenon. Governments shut everything down, and so businesses canceled orders, factories were shut, and so forth. And so then, as things began to open up, it's not just like throwing a switch, right? It's where everything just starts to flow again. It's that whole interruption and so forth. And we were still experiencing that in 2021, even before Ukraine, right?
Yes, and I'm glad you mentioned that. Certainly in the springtime in the US last year, we did start seeing in-person services reopen, things like amusement parks and restaurants and sporting events. And people started going on vacation. And with that, you had a surge in pricing because, again, you had issues in terms of something I forgot to mention, labor shortages. And labor shortages last year were a function of a number of issues. Number one, lots of people retired during the pandemic and probably weren't going to come back. Many people were concerned about their own health. You also had restrictions on mobility, as you mentioned, by governments and agencies. And so we just didn't have enough people to enter into those services professions. And so many businesses were scrambling and bidding up wages to get people to come in, and also the inputs, right? So if you're a restaurant and all of a sudden, it costs more to pay for food, those prices are getting passed on to the customer. So we saw a big spike in services inflation in the springtime last year. But then we had two more variants that depressed services, certainly Delta and Omicron. But even fast forwarding to now, we're starting to see some evidence where as mobility restrictions are falling away and masking restrictions are ending, that people looking to engage in in-person services. We certainly saw that in retail sales in the last reading.
Yeah, and there's this whole concept of the supply chain, which we've talked about in the press, but it's really from raw materials all the way to the consumer or the customer if you're talking about goods. And there's this whole cycle where some of the input costs went up, so then manufacturers would raise prices that would get reflected at the consumer level. But then, as you said, wages go up, and that comes all the way back to the beginning of the supply chain, and suppliers then have to raise costs again, so there's this sort of this cycle that just keeps going around and around. How long does that go on?
Sure. So I think there are two issues with that cycle that I'd like to talk about in terms of inputs. Number one are transportation costs, and number two are chips, semiconductor chips, computer chips. So when we look at transportation costs, they skyrocketed last year. Certainly, when we look at the U.S., you had issues in terms of not enough people to offload those big freighters, those big tankers with all the goods that Americans were buying. And so you had hundreds of ships sitting outside of ports. And even once you were able to get those ships into the port, you didn't have enough dock workers, and then you certainly didn't have enough truckers. And some of the trucker issue was related to regulation, and some of it was just a lack of people to actually drive the trucks. And so those transportation costs were passed on through the pipeline to the consumer. Now let's talk about semiconductor chips. That I think is something, well, okay, let me go back to transportation. Certainly as the demand for goods wanes and people go back to buying more services, the pressures on transportation could lift. Now, but there's a caveat to that. Certainly if oil prices remain elevated and even go to 200, we're going to continue to have transportation issues. But going back to the semiconductor chips, I think that issue is not going to go away in terms of shortages. Certainly, when we think about chips, they go into everything from automobiles to appliances to your cell phone to whatever gadgets you're using. If you have kids or grandkids, their video games. And so there's just going to continue to be strong demand from both businesses and consumers for high-tech gadgets and things that need semiconductor chips. So I don't think that's going to go away, simply because it takes a long time to build a chip factory, and there's just going to be continued demand in the foreseeable future.
Yeah, a long time and a lot of money. But going back to the supply chain or the transportation piece of it, it is interesting because a lot of this starts in China. We have a lot of our global manufacturing in China. It has evolved there over the past few decades because of the low cost of labor, which offset the cost of transporting it around the world. But with the shortages here, first of all, that great disruption, the shutdown. But these disruptions continue. I mean, the Chinese government has an approach to COVID, which is, lockdown. And, even as we speak, you've got large portions of Shenzhen and the ports shut down again, which disrupts the whole flow of goods. And each of these little tiny pieces to the supply chain add up. So, you can produce a car, except you have this one little part that's sitting on the port in Shenzhen. And so therefore you can't deliver the whole car. So these disruptions keep happening. And I think this is why it was so hard, I think, for economists last year. Initially, inflation was described as being transitory, meaning that, okay, once we get through these things and get through the cycle, it'll be okay. It'll work its way out. But it keeps happening. And so this is the confusing thing to people. Why? I thought it was transitory. What is it now? And it's because of these, continued cycles of disruption, isn't it?
Yeah. So just first a comment on China. You're absolutely right, Steve. A lot of the supply chain disruptions did start there because the government had a zero COVID policy, and also many other Asian economies that are in early and intermediate parts of the global supply chain, especially in high-tech goods, And it's interesting in the news, I saw just today that the Chinese government is looking to be a little bit more lenient, recognizing that the shutdowns are very strenuous on their economy as well as the global economy. So there could be some loosening there. But again, you're right in terms of, I think people thought a lot of the inflationary pressures would be quote unquote transitory because they were expecting the pandemic to end, but it didn't. Going back to March of 2020 when the pandemic, really was evident in the US, most people were thinking, oh, this will be like like a hurricane. It'll come through and that's it. We all recover. But here we are, almost 3 years later, and we're still grappling with the pandemic. And because you had the continuation of the pandemic, repeated shocks, the inflation moved from being transitory to persistent.
Yeah, and that's different than what we thought it was going to be, and certainly in 2020 and 2021. And I suspect that if we knew what we knew today, we might have done things. The Fed and the federal government may have done things differently, back then. But of course, it's 2020 hindsight, right?
Indeed, hindsight is 2020. I think, certainly in terms of what the Fed might have done, the Fed has changed, I think 2 years ago, changed its mandate, right? So they have a dual mandate of attempting to achieve full employment, but also, low and stable, predictable inflation around a 2% target. And then they expanded upon that, where they said employment needs to be broad and inclusive. So that means that you're not just looking at the overall unemployment rate, which was coming down quite nicely, but you're looking at other metrics like how are women doing? How are persons of color doing? And so, how is labor force participation doing? So with all those metrics, they wanted to be more patient in terms of allowing a little bit more inflation if it meant more jobs. But then inflation got out of hand, which I think surprised the Fed. And so now, with the last meeting, the Fed is signaling a very hawkish tone, where they intend to raise interest rates very aggressively. Well, aggressively meaning potentially every meeting, raising rates to almost 2% this year and then close to 3% next year, and also reducing the size of its balance sheet, which is about another quarter percentage point hike there.
Yeah. So, so that's the Fed. We'll come back and talk more about the Fed. It's interesting to me that recently I've heard many politicians, and we're nonpartisan, so this shouldn't be interpreted as, a targeting or a comment towards one party or another, because they're all doing it. But a lot of these politicians are stating that large levels of federal stimulus have not created inflation. And in fact, the large levels of federal stimulus has lowered inflation. Now, I realize these are politicians and then they're not trained necessarily as economists, but give us your thoughts on those kinds of comments.
Sure. Again, we're nonpartisan, so I'm not going to point the finger at any one particular politician. But from an economic point of view, fiscal stimulus, depending on how it's done, is inflationary. So what was done was households were given cash in the form of checks, in the form of breaks for having children, and so what do people, the intent was for people to go out and spend it. If people go out and spend it all at the same time, millions of Americans spending and buying things that are also in short supply, so you have the demand and the supply shocks smacking together, you're going to get inflation. And that's exactly what we saw.
Yeah, and it's, again, 2020 hindsight, but, when we were sitting at the pandemic, we shut everything down. We didn't know how long it was going to last. And the government was trying to replace that income so people would not miss meals and, be able to continue to pay rent and those kinds of things. But then they did it again, with another $2 trillion bill. So I think most economists, I don't mean to put words in your mouth, but I think most economists with the benefit of 2020 hindsight, say, okay, we went a little bit too far. But you're right; it was a lot of money out there seeking, a fixed supply, and that drives prices up. It's the law of supply and demand, and that created some of this inflation. So it's very helpful to think through this, not to be critical, but just to try to explain it. We've talked about the trends in U.S. inflation and some of the factors driving it. Next, we're going to come back and talk about what can be done right now to address inflation, and then how long will it take? We're going to take a short break. We'll be right back with my conversation with Dana Peterson.
As war rages in Ukraine, the Conference Board is closely monitoring the situation and producing timely and relevant content on a daily basis that will help the business community navigate this global geopolitical unrest. What will the impact be on oil prices, food prices, our supply chain, and what about cybersecurity? How will this conflict impact the way your organization does business around the world? And how will you communicate this crisis to customers and employees? We're gathering the very latest content on our website. Just head to conference-board.org and find trusted insights to help you and your team lead with confidence.
Welcome back to CEO Perspectives. I'm your host, Steve Odland, the CEO of the Conference Board, and I'm joined today by the Chief Economist of the Conference Board, Dana Peterson. Okay, so Dana, we've talked about some of the causes of inflation. So what should everybody do? What should the Fed do right now? You talked about, what their plans are. Do you agree with those plans? Do you think they should be more aggressive, less aggressive? And then also, what should Congress do?
Sure. So I think the key thing is to understand the different drivers of inflation. I talked about this a little bit earlier. You have demand drivers and supply drivers. Now, the Fed, in terms of raising interest rates, can address the demand elements. So what are the three demand elements? Number one, you have very strong employment. Most people are employed. Our unemployment rate's incredibly low. And even though the participation rate is not back where it was, again, we have to remember many people retired, and you still have a number of people who are in the services sector that are going to be coming back online. So very high employment, wages are up, right? You also, so that's one, those are two elements, if you will. Another element is that you had many people again receive those fiscal injections, and some of it was saved, and so there's still pent up capacity to spend. And so if you fold those things together, and also very strong consumer confidence, even though it's not as high as it was pre-pandemic, but people are still saying by our own measures they're looking to spend. So the Fed can influence those demand elements by raising rates. However, the Fed can do nothing about supply side shocks. And the two main supply side shocks that we're seeing are, number one, the lingering effects of supply chain disruptions from the pandemic, adding on supply chain disruptions from the war in Ukraine. So that's the first. And then the second are the supply side shocks we're seeing to commodities prices due to the war in Ukraine. Those prices include energy, so oil and natural gas, food, particularly cereals, which go into everything from your cereal, your oatmeal, to the protein that we eat because the animals eat the food, and also even ethanol in terms of corn. And also I would fold in metals. Metals prices are rocketing, especially for nickel and gold. And nickel and gold are key elements for producing computer chips. So you have these two supply side shocks that the Fed can do nothing about. So that's going to really challenge the pace of the decline or the softening in inflationary pressures.
So it sounds like you agree that the Fed should do what they're doing, which is to raise rates and to to start to sell off their balance sheet. Do you think that they should be more aggressive? Each time they raise it, they went a quarter of a point. Some people were arguing that it should be 100 basis points. What do you think?
So, like you said, it seems like the plan is for 25 basis points per meeting. It's not baked in. It just looks like it for the path, but at any meeting they can go 50 basis points. I personally thought they should have gone 50 basis points or more at this first meeting to put out a very even stronger statement that we are trying to address inflation. But again, markets were expecting 25 basis points. So they want to have a nice balance between not causing the US economy to slow down too quickly or to create too much volatility in financial markets that feeds through to consumer expectations that also affects growth. So I think, yes.
And that's what happened in the 70s, where they moved very, very rapidly. They cut the growth, and they still had the inflation, and which was nicknamed stagflation, which is just kind of the worst of all worlds, right?
Yes. Other than recession, that's probably worse.
Exactly. Okay, so so Congress, of course, is the branch of the government that allocates all spending, makes all the laws too. Anything that you think Congress should be doing differently to battle inflation?
Sure. And some of this is not necessarily going to be resolved overnight, but certainly Congress can direct funds and investment towards building out infrastructure that can help lower costs, right? If we think about the transportation snarls,
all the bottlenecks,
yes, all those things, a lot of it's just poor infrastructure. I mean, I live in the New York area, and there are potholes everywhere.
Yeah.
And, there are just not enough roads, et cetera. There are not enough ports. So Congress can certainly redirect funds into R&D and infrastructure that can help build out the productive capacity of the US economy to help lower inflation over the longer term.
Yeah, and this is what we did in the 80s. People may remember back, we did put a little debt out there, although it was down around 30% debt to GDP, but we did put a little debt on, but we built out the capacity of our infrastructure such that we then took the next 10 to 20 years to grow into it. And so what I hear you saying is we're kind of at capacity, certainly in the road system, bridges, ports, inland waterways, but also energy. The grid is at capacity too. So all of these things, which was part of what was behind the infrastructure bill, but it does take a long time to get this stuff done and through the system. So you're saying if they could find some way to speed that up and make that happen faster, it would be really productive, right?
Yes, and I would also suggest in the short run, I know that there are aims, and the global economy will ultimately get towards greening, but in the short run, we need to create on ramps, right? You can't just jump on the highway of green energy and just abandon all of your current infrastructure and fossil fuels. There needs to be a transition, and that's where policymakers can come in to help with regulation, and also positive regulation, and also investment, and also allowing private investors to hop in there to help support that transition.
Yeah, let's talk about energy. I read something the other day which I thought was really interesting. It in a million years of human evolution, it took from the invention of fire, it took all that time to evolve from burning wood to burning other fossil fuels like coal and that which has been going on for the past 150 years, to the transition to natural gas, which has been the last couple of decades, and now we want to transition to renewables. And we're thinking about it, but we kind of have shut off some of the supply of fossil fuels, and a little bit of that was deliberate in order to try to force the investment in the renewables sector. However, at the same time, then you have this global shock, because of Ukraine and otherwise. So what should the US be doing right now to increase supply in the short term? And then how do we balance those short-term needs with our long-term carbon goals?
Sure. So in the short run, it's quite complex. That you have two elements here. One element is you have private investors who are, invest in companies that drill oil and wildcat and then refine it. And those investors are wary of planting money in an industry that may be going away, right? And also just thinking about oil prices, how they've spiked and then come off, and then they could spike again. There's so much volatility, and investors are looking back to 2008 and saying to themselves, well, prices got but so high and then they collapsed, right? I mean, we did have a recession, major global recession, but they're like, we don't want to be caught out there. But then when you look at the logistics, you don't have enough workers, You can't just turn on the spigots. There's, physical things you must do to actually draw up the oil. You don't have the equipment. And so you have a lot of barriers to really starting up production, from the investment side to just, the practicality of it. And so in the short run, yes, it means that we're going to have to tap into some of our reserves.
Yeah, so it comes down to, a little bit of common sense here. It's not either or. I mean, so many people say, well, it's either renewables or oil, and you're either on one side or the other. But I think what I hear you saying is there needs to be a long-term plan. We've got to deal with climate change and carbon's impact on that. We've got to reduce it, but you can't just throw a switch and make it happen overnight. You've got to have a ratable plan to get there, and you've got to put the infrastructure investments in place so that we can get there over time without destroying the economy in the meantime. I don't mean to put words in your mouth, but that's what I hear you saying, which is, I think probably where most people are, and you just wish sometimes you could get the policymakers to to tone it down. All right, last question. Inflation was tame for a long time. I mean, 10, 20 years. I mean, very tame. 2%, under 2%, and I think a lot of people, kind of became complacent, and they didn't realize that, gee, this could really pop and get out of control very quickly. And so it surprised a lot of people. But now getting the genie back in the bottle is a task, and you pointed out the means to do it. What kind of timetable should we expect to get back to, normal, quote unquote, 2% or under?
Well, I think under 2% is probably not going to be the new normal. It's probably going to be somewhat above 2%. And the Fed has even said that, they're fine with inflation floating a little bit above 2%. But it's going to probably take a couple of years. And when we look at our inflation forecast for this year, we have very high inflation. When you look at the Fed's personal consumption deflator, which is what the Fed likes to pay attention to, both overall and then less food and energy, we have those measures being very elevated for much of this year and even next year. And even by the end of the next year, maybe not even getting closer to 3% inflation. So 2% inflation might not happen until 2024, unless there is, the R word that happens where you could see prices really collapse because you're seeing this shutdown in demand.
The R word meaning recession, which we don't want, which would be worse than having a little higher inflation for a while. So.
Right. And it's not our base case.
It is not our base case.
But it certainly is always out there as a risk.
So a couple more years of, work from the Fed and, constraints from our spending, and hopefully we'll get there. And then that assumes that, geopolitics also resolve themselves in some favorable fashion, right?
That's the hope.
That's the hope. Dana, thanks so much for joining us today.
Thanks, Steve. Always great to be here.
And thanks to all of you for listening in to CEO Perspectives. Every week, I'll be joined by a prominent thought leader to provide insights on the issues of our time. We'll cover the leading topics in economics, public policy, ESG, human capital, and more. Please share CEO Perspectives with your colleagues, with your friends, with your neighbors, with anyone you know. I'm Steve Odland, and this podcast has been brought to you by the Conference Board.
You've been listening to a podcast from the Conference Board, your source of trusted insights for what's ahead. For the latest insights to help guide your business through this time of geopolitical unrest, we have daily and relevant updates on our website at conference-board.org.